Gold is money and has been money and a store of value and a measure of wealth for thousands of years. So not the paper pound. Paper pound is trash. It's going to zero. But what I'm trying to say here is that Rachel Reeves will fail if she taxes property, because there isn't that much wealth there, as you can see. You only need 109 ounces of gold to buy the UK average house price. We're near the bottom there in 1982 of 90, and I think we could even go through that bottom in 1982.
Gold's impressive rally in 2025 has drawn significant attention from analysts and investors alike, with voices such as Mario Innecco pointing out that its upward momentum is not just a market phenomenon, but a clear reflection of deeper structural cracks in the global financial order. Having surged more than 25% year-to-date and holding well above last year's levels, gold's performance represents far more than speculative appetite. It embodies the growing distrust in fiat currencies, the lingering pressures of persistent inflation, and the increasing fragility of the world's economic systems. Traditionally dismissed in strong economic cycles as less lucrative compared to equities or other risk assets, gold repeatedly reasserts itself as the ultimate safe haven when confidence in financial stability falters. The trend has not been without brief corrections, but the long-term direction remains sharply higher, mirroring past cycles of monetary stress where gold proved indispensable for capital preservation. More investors are now turning to exchange-traded funds, futures contracts, and other vehicles to gain exposure, seeking both liquidity and adaptability in uncertain markets. This shift highlights a broader transformation in investor psychology, as reliance on gold reflects diminishing trust in central banks and their ability to manage crises effectively. Innecco has underscored that this pivot away from paper assets toward something tangible and immutable demonstrates how confidence is quietly migrating from promises and policies to real, enduring value. Gold, unlike currencies that can be printed at will, retains a credibility that modern financial systems struggle to replicate. Market dynamics reinforce this evolving narrative. Spot prices continue to serve as a critical gauge of sentiment, with sustained buying pressure underscoring the demand for protection against inflationary erosion. Meanwhile, futures markets, even when priced in contango, reveal expectations of strength extending well into the future despite storage and carrying costs. This suggests that investors are not merely reacting to short-term volatility, but are preparing for longer-term instability in the global order. As inflation questions linger and doubts grow over whether central banks truly have the tools or the trustworthiness to restore stability, gold is increasingly moving from being seen as a speculative trade to becoming an essential anchor of wealth preservation. Before we dive into Mario's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
Foreign investors own about 30% of UK government debt, which is quite significant. They will want more for their investment, i.e. they will want a better return. So the secondary market will sell UK government bonds and the yields will rise, and that might attract investors. But all that will do is that will raise the government's interest expense on the debt, which is rising quite a bit already in the last 2 fiscal years that we have data for, and we're going to look at that in a minute. Number 4, the big culprit is the central bank, the Bank of England, because did you know that we're paying billions to the Bank of England, yes, the taxpayer, for the losses that it's accruing on its portfolio of government bonds that it bought to bail out the system since 2008, yes. And I'm going to come to that data now too. And also to the interest expense. Done a little bit of research here, so you can see that interest expense as a percentage of GDP had been pretty steady, up until, let's say, 2021. You can see that after the 2008 crisis, it rose a little bit to the mid 2.5% range. Then it dropped again. But now in the tax year 22-23, it was 4.3%. So that was a post-war high. as interest rates surge, so higher yields don't help. And then 23, 24, it stabilized a little bit because they got the government bond yields under control. It's at 3.9. And the forecasts for 24, 25 are not that great. They're supposed to drop to 3.7% of GDP and 3.6. But I have asked ChatGPT, I have used ChatGPT, and I asked if gilt yields were to rise 150 basis points or 1.5%. I asked what that would do for the interest expense forecast for 2026, 2027. And it's not good. It says it would raise it to around 4.2 to 4.4%. And yes, this is a really important aspect that we need to keep an eye on. It's the gilt market. And I think the UK Treasury, the government, the Bank of England, they are desperate to keep those yields from rising too much further. I think they're going to have a tough time. The bond vigilantes are back. And as I said, foreigners own a third of UK debt. And yes, the pound has rebounded this year versus the dollar, but I think it's going to turn around because our economy is in dire straits, and that could accelerate that. What about the Bank of England? The real culprits for all our woes, I think, and I'm not like saying that people, the general public, that small majority is not to blame, because they are. The democracy, the system is to blame, of course, but the Bank of England makes it possible by printing reserves out of thin air and pumping up the banking system. So I asked ChatGPT as well about the Bank of England and how much we've paid back to them in the last few years. So it says here 85.9 billion has been paid by the Treasury to the Bank of England to cover the asset purchase program, which is actually a private limited company, and that's from 2022 to 2025, and it's expected to rise to a total of 133 billion. And just remember this, that Rachel Reeves' fiscal hole for this coming budget is 50 billion pounds. So we've given already the Bank of England 86 billion. So who had this bright idea to compensate the Bank of England for its bad investments? What were the Bank of England's bad investments? Well, buying government bonds. The Bank of England saved the day in 08, 09, and 2020. It allowed the government to borrow and pay people to stay at home and not work, and bail out people who had bought houses they couldn't afford. Yes, that's what the Bank of England's done. It's not the baby boomers that are to blame for all the wealth inequality. House prices. The leftists are saying, the baby boomers, they've got all this wealth, that's trillions of pounds of wealth in property value, but it's not. It's a symptom of a dying currency, and anything that's solid and useful, like a house, becomes worth a lot. But if you look at house prices here, and I've been doing this for many years on the channel, it's the nationwide average UK house price to gold ratio. So what does that mean? Well, it means how many ounces of gold you need to buy the average UK house. And as you can see, back in 2004, you needed 672 ounces. So that was when UK houses were the most overvalued relative to gold. And why do I look at gold? Well, because gold is money and has been money and a store of value and a measure of wealth for thousands of years. So not the paper pound. Paper pound is trash. It's going to zero. But what I'm trying to say here is that Rachel Reeves will fail if she taxes property, because there isn't that much wealth there, as you can see. You only need 109 ounces of gold to buy the UK average house price. We're near the bottom there in 1982 of 90, and I think we could even go through that bottom in 1982. The data is from the Nationwide, and it's since, I think, 1952. So, yeah, it's always good to look at things through a different lens. And when you look at value and prices through the paper pound or the fiat pound, things are very different than when you look at it through the price of gold. And it just goes to show that baby boomers are not to blame for our predicament. The system is to blame. The central banking fiat currency system, that base system, is to blame.
Mario Innecco is drawing attention to gold's position in today's markets, highlighting how its strength stands apart from other precious metals. While silver is known for its explosive rallies during late bull runs, its volatility and dependence on industrial demand make it less reliable as a safe haven. Platinum and palladium, though useful for diversification, are tied heavily to industrial cycles and lack gold's universal recognition as a monetary anchor. Gold, on the other hand, holds a dual identity that sets it apart. It is both a commodity and a currency, trusted across centuries and political systems. Innecco emphasizes that this rare combination gives gold a level of credibility that outlasts governments and financial institutions, solidifying its role as the ultimate refuge in times of economic strain. The real question, however, is whether the surge we are witnessing now is just another phase of market enthusiasm or the opening act of a far more profound revaluation. As global debt mounts, fiat currencies lose purchasing power, and inflationary pressures linger, Innecco warns of what he calls a potential loss of faith event. Such a turning point would not simply boost gold temporarily, but could reshape the way wealth is preserved in the years to come. If 2025 proves to be the threshold for this shift, gold's ascent may not be a short-term hedge. It could mark the beginning of a new era where trust in paper currencies gives way to the enduring strength of tangible money.
There's a lot of speculation about all the taxes that Rachel Reeves, our Minister of Finance or Chancellor of the Exchequer, is going to resort to. Not that she hasn't resorted already to a lot of taxation. There's even talk that they're going to tax an Englishman's castle, which is his home, with a wealth tax, and that hasn't gone down well. But it could be just kind of management of perception. They scare the public going into the statement, and then it comes out and it's not as bad. But we'll have to wait and see. But the purpose of this talk with you today is to show you that there's no way out of this except a major shift in philosophy, and I don't see that happening. And what do I mean by there's no way out? Well, there's no way out of saving a dying currency. Yes, that's what we have. And also, we are at the end game in terms of democracy. Not that I see a dictatorship coming up, but democracy always leads to bankruptcy because you have the tyranny of the majority, basically oppressing the individual and also destroying property rights. Yes, property rights are a really important part of an economy if you're going to run it as a free market economy. And that's what we're supposed to have. But we've gone way out of this paradigm, and we're like going at very fast pace towards the end game. So before I go through why it's going to be really tough or nearly impossible for things to be salvaged, just wanted to thank you all for your interest in the channel. We're getting more and more subscribers as usual. Yes, it's a dying currency, and if you've been listening to me for many years, you know that fiat currencies always go to zero, and that the backing for fiat currencies is the debt, and that governments and states love fiat currencies because they can give the voters freebies. And that's why we are in such a predicament. Alan Greenspan, despite all his faults for being a central banker, wrote a very interesting article back in the 60s entitled Gold and Economic Freedom. And he let us know that without a sound money or gold convertible money, there is no limit to how much the state can spend, and the people, the public, that tyranny, that majority that oppresses the individual and free markets and private property, they're in charge. And we are at a point right now that, especially here in the UK, we are at the forefront, I think, of all the Western nations, and we're going to fall first. We get to a point where there's no more money. I think it was Margaret Thatcher who said the problem with socialism or statism, and it's not just socialism, it's also subsidies to and bailouts for businesses. But as she said, eventually we run out of other people's money, and Rachel Reeves is desperate to get people's money, but that's going to make things worse. So let's go through why it will make things worse. Well, number one, it will kill the private sector or the productive sector. And what does that mean? You don't have to be a PhD economist to realize what happens. Well, there's going to be the supply of goods and services is going to shrink in the economy. And why would more taxes, especially a wealth tax on your property? They're talking about, I think, a tax on every property worth more than £500,000, which is almost all the properties in the southeast of England, or at least in the whole of Greater London. Well, that means people feel less wealthy. They have less money to spend because aside from paying their council tax, they're going to be paying the wealth tax. And I'm not sure if your house is worth more than 500 and you paid this wealth tax, whether you would be exempt from the council tax, but I don't think you will. So that's how it affects things. It will kill the economy. We're seeing already that
the years ahead could bring a profound transformation in how societies measure and preserve wealth. For much of modern history, faith in government-backed currencies has been the cornerstone of the financial system, but that trust is gradually being eroded. Mounting debt levels, persistent inflation, and weakening economic growth are raising doubts about the ability of central banks to maintain stability. As more people question whether paper money can continue to serve as a reliable store of value, the search for alternatives is intensifying. Gold, with its limited supply and centuries-old reputation as a protector of wealth, is increasingly seen not as a speculative trade, but as a safeguard against the fragility of the financial system. If this trend continues, the world could be on the cusp of a historic revaluation where tangible assets reclaim dominance over paper promises. In such a scenario, gold would not just act as a hedge against turbulence, it could become the backbone of financial security in an era where trust in currencies is fading. This potential shift would redefine how wealth is preserved, how trade is conducted, and how nations manage their reserves. What looks like short-term volatility today may, in hindsight, be remembered as the early stages of a global monetary reset, where the balance of power shifts from fiat currencies to hard assets, signaling the dawn of an entirely new financial order. That's it for today. If this video provided value, please like, share, and comment below with your thoughts. Your perspective helps deepen the conversation and keeps everyone informed.